There is a crisis brewing that almost nobody is talking about. A crisis that could trigger the next major market crash. A crisis that affects tens of millions of Americans who have no idea their retirement is at risk. I am talking about the pension crisis, and it is far worse than most people realize. When I look at the pension system today, I see the same patterns I saw in the housing market in 2005 and 2006. I see promises that cannot be kept. I see accounting gimmicks that obscure reality. I see mathematical impossibilities being treated as viable long-term plans. And I see millions of people who are going to be devastated when the truth finally becomes undeniable. I have spent my career finding the hidden risks that others overlook. I predicted the 2008 housing crash years before it happened. I saw the subprime mortgage disaster coming when everyone else was celebrating record home prices and easy credit. I read the documents that nobody else bothered to read. I analyzed the data that everyone else ignored. And I made one of the most profitable trades in financial history by betting against a market that everyone believed was invincible. I remember sitting in meetings with Wall Street executives back then. They looked at me with a mixture of condescension and pity. They thought I did not understand how sophisticated the financial system had become. They thought I was missing the big picture. They thought their models were infallible and their structures were sound. They were wrong about all of it, and millions of Americans paid the price for their arrogance. Now I am seeing similar patterns in the pension system. Not identical patterns, because no two crises are exactly alike, but the same fundamental dynamics. Promises that cannot be kept. Accounting tricks that hide the true extent of the problem. Assumptions that are wildly optimistic. And a widespread belief that someone, somehow, will fix everything before it is too late. I have been studying pension data for years. I have read the actuarial reports that most people find incomprehensibly boring. I have built models to stress test different scenarios. I have talked to pension administrators, union leaders, state budget officials, and corporate finance executives. What I have found is deeply troubling. That belief that everything will work out is going to be tested, and millions of Americans are going to discover that the retirement they were promised does not exist. Today, I am going to walk you through exactly what is happening, why it matters, and what you can do to protect yourself before this crisis reaches its inevitable conclusion. Let me start by explaining the scope of this problem, because most people have no idea how large it is. We are talking about trillions of dollars in unfunded liabilities. Trillions, not billions, trillions. To put this in perspective, the entire annual economic output of the United States is about $28 trillion. The total value of the American stock market is roughly $50 trillion. The pension funding gap is measured as a significant fraction of these numbers. This is not a minor accounting issue that can be swept under the rug. This is an existential threat to the retirement security of an entire generation. Public pension funds in the United States, the plans that cover teachers, firefighters, police officers, and other government workers, have a funding gap of somewhere between $4 and $8 trillion, depending on whose assumptions you use. Let me repeat that number because it is staggering. $4 to $8 trillion in promises that have been made to workers but for which money has not been set aside. That range, 4 to 8 trillion, tells you something important about the nature of this problem. The uncertainty itself is massive. We are not talking about a precise liability that everyone agrees on. We are talking about a range that varies by a factor of 2 depending on what assumptions you use. This ambiguity has allowed politicians and pension administrators to choose the most optimistic assumptions, making the problem look smaller than it actually is. Private pension plans are in better shape on average, but still have hundreds of billions in unfunded liabilities. Corporate America has been trying to shed these obligations for decades, freezing plans, converting to cash balance formulas, and encouraging workers to take lump sum buyouts. But many companies still have significant pension obligations that could threaten their financial stability. Look at companies like General Electric, which struggled for years partly due to its massive pension obligations. Look at legacy airlines that went through bankruptcy partly to restructure their pension plans. Look at steel companies, auto companies, and other industrial giants that have been weighed down by retirement promises made decades ago. These are not abstract problems. These are real companies that have been fundamentally weakened by pension liabilities. And then there are the multi-employer pension plans, which cover workers in industries like trucking, construction, mining, and retail. These plans are in catastrophic condition. Many are projected to run out of money within the next decade. The federal insurance program that backs these plans, the Pension Benefit Guaranty Corporation, is itself deeply underfunded and cannot cover the expected failures. The Pension Benefit Guaranty Corporation is supposed to be the backstop, the safety net that protects workers if their pension plan fails. But it is like an insurance company that has written policies on houses it cannot afford to rebuild. The PBGC's multi-employer program has liabilities that exceed its assets by over $60 billion. When major plans fail, the PBGC will not be able to make workers whole. Add it all up, and you have a problem measured in the trillions of dollars. A problem that affects the retirement security of tens of millions of Americans. A problem that most politicians refuse to address because the solutions are painful and the consequences seem distant. But the future is arriving faster than anyone expected. Let me explain how we got here, because understanding the history is essential to understanding why this crisis is so difficult to solve. Pension plans work on a simple principle. Workers earn benefits during their careers, and those benefits are paid out during retirement. To fund these future payments, the plan sponsor, whether a government entity or a corporation, makes contributions into a trust fund. That money is invested, and the combination of contributions plus investment returns is supposed to cover the promised benefits. This system worked reasonably well for decades. In the post-war era, when the American economy was growing rapidly and companies were profitable, pension contributions flowed in steadily. Investment returns were strong. The ratio of active workers to retirees was favorable. Pension funds accumulated assets and paid benefits without major difficulty. But the system contained the seeds of its own destruction. The fundamental problem is that pension benefits are a promise about the future, but humans are notoriously bad at planning for the future. Politicians face elections every few years. Corporate executives are judged on quarterly earnings. Union leaders negotiate for benefits their current members will receive. Nobody has strong incentives to worry about whether promises made today can be kept 30 or 40 years from now. The critical assumptions are how much money will be contributed, what investment returns will be earned, and how long retirees will live. Get any of these assumptions wrong, and the plan becomes underfunded. For decades, plan sponsors have been getting all three assumptions wrong. They have contributed less than they should have, often because politicians wanted to spend money on other priorities or corporations wanted to boost short-term profits. They have assumed investment returns that were unrealistically high, allowing them to report smaller funding gaps than actually exist. And they have underestimated how long people will live, meaning benefits have to be paid for longer than expected. Let me walk through each of these failures in detail. On contributions, the pattern has been remarkably consistent across public and private plans alike. When times are good and pension funds are doing well, sponsors skip or reduce contributions. They tell themselves the fund does not need the money right now. They use the money for other purposes, whether tax cuts, spending programs, or corporate investments. Then when times are bad and the fund is struggling, sponsors cannot afford to make the contributions because revenues are down and budgets are tight. This creates a ratchet effect where underfunding grows over time, regardless of economic conditions. Good times lead to skipped contributions. Bad times lead to insufficient contributions. The funding gap widens in both environments. I have seen this pattern in state after state, company after company. New Jersey skipped pension contributions for years to balance its budget. Illinois borrowed money for operating expenses rather than funding its pensions. Corporate executives used pension contribution holidays to boost reported earnings and their own compensation. The short-term incentives always won over long-term responsibility. On investment return assumptions, the manipulation has been even more egregious. Most public pension plans assume they will earn investment returns of around 7% per year. This assumption directly determines how much money needs to be contributed today to fund future benefits. A higher assumed return means lower required contributions. A lower assumed return means higher required contributions. 7% might have been reasonable decades ago when interest rates were higher and equity valuations were lower. But today, with 10-year Treasury yields around 4% and much of pension portfolios allocated to bonds, 7% is extremely aggressive. To achieve 7% returns, pension funds have to take on significant risk in stocks, private equity, hedge funds, and other alternative investments. Some actuaries and economists argue that the appropriate discount rate for pension liabilities should be much lower, perhaps 4 or 5%, reflecting the risk-free rate of return. These are guaranteed obligations, after all. They should be discounted at rates that reflect their certainty, not at rates that assume risky investments will always pay off. If you use a lower discount rate, the present value of future liabilities increases dramatically. The $4 trillion funding gap becomes $6 trillion or $8 trillion. The problem is much worse than the official numbers suggest. Politicians and pension administrators resist using lower discount rates because it would require much higher contributions, which means either higher taxes or cuts to other government services. So they continue using optimistic assumptions that mask the true extent of the underfunding. They are not technically lying, but they are not telling the truth either. This is not fraud in the legal sense, but it is deeply misleading. Workers are being told that their pensions are funded at 70 or 80% when the true funding level might be 50% or less. They are making life decisions based on promises that may not be kept. On longevity assumptions, the errors have been more understandable but equally damaging. People are living longer than actuaries predicted. Medical advances, improved nutrition, and healthier lifestyles have extended life expectancy significantly over the past several decades. Every additional year of life means another year of pension payments. When pension systems were designed, the typical retiree might collect benefits for 15 or 20 years. Today, many retirees collect benefits for 25 or 30 years. Some collect for even longer. A worker who retires at 60 and lives to 95 is collecting benefits for 35 years. That is far longer than any actuary in the 1970s or 1980s would have predicted. The cumulative effect of these three errors, underfunding contributions, overstating investment returns, and underestimating longevity, has been devastating. Year after year, decade after decade, the funding gap has grown, and now it has reached a size that cannot be ignored. Let me walk you through the mathematics of how pension underfunding compounds over time, because this is crucial to understanding why the problem has become so severe. Imagine a pension fund that should have $100 billion in assets to meet its obligations, but only has $70 billion. That $30 billion shortfall does not stay constant, it grows. If the fund is supposed to earn 7% per year on its assets, that means the $70 billion should generate about $5 billion in returns. But the fund needed $7 billion in returns to stay on track with its $100 billion target. So the shortfall grows by $2 billion in the first year alone. Now the fund has a $32 billion shortfall. The next year, the gap grows even more. And the year after that, even more. This is the tyranny of compound interest working against you instead of for you. The shortfall compounds just like investments compound, but in the wrong direction. Add to this the fact that benefit payments are accelerating as more workers retire. The fund is not just failing to earn enough returns, it is also having to sell assets to make benefit payments. So assets are declining while liabilities are growing. The gap widens from both ends simultaneously. This is why pension crises tend to accelerate rather than stabilize. Once a fund reaches a certain level of underfunding, the mathematics work against any recovery. The fund would need extraordinary investment returns or massive contribution increases just to stay even, let alone close the gap. Neither is realistic. I have modeled these dynamics extensively. I have run scenario after scenario, trying to find paths where severely underfunded pension funds recover without either benefit cuts or bailouts. The paths do not exist. The math does not work. The only question is how and when the reckoning comes. Now let me tell you about the demographic time bomb that is making everything worse. When pension systems were designed, the ratio of active workers to retirees was much higher than it is today. There were many workers paying into the system for every retiree drawing benefits. The math worked because contributions from current workers could help fund current benefits while investment returns compounded over time. But demographics have shifted dramatically. People are living longer, so they draw benefits for more years. Birth rates have declined, so there are fewer young workers entering the system. And the baby boom generation is now retiring in massive numbers, shifting from being contributors to being beneficiaries. In many pension plans, particularly mature public plans, the ratio of active workers to retirees has fallen below 2 to 1 or even 1 to 1. This means that the contributions from current workers are barely enough to cover current benefit payments, leaving nothing for investment and compounding. The plans are paying out more than they are taking in, and they are eating through their assets. This is a death spiral. As assets decline, the plans have to take more risk to achieve their assumed returns. As they take more risk, they become more vulnerable to market downturns. A major market crash at the wrong time could push many plans over the edge into insolvency. Think about what happens when a pension fund has to sell assets to pay benefits during a market downturn. They are selling stocks when prices are low, locking in losses, and reducing the asset base that could have recovered when markets rebounded. This sequence of returns risk is one of the most dangerous dynamics in pension finance. Let me tell you about some specific examples, because the abstract numbers can be hard to grasp. Illinois has one of the worst pension crises in the country. The state's pension systems are funded at less than 40% by some measures. The unfunded liability exceeds $150 billion in a state with an annual budget of around $50 billion. The state constitution prohibits reducing pension benefits, so the only options are massive tax increases, drastic cuts to other services, or some form of federal bailout. Illinois is already one of the highest tax states in the country. Property taxes are crushing. Income taxes are high. Businesses and wealthy residents are leaving for lower tax states like Florida and Texas. There is a limit to how much more can be extracted from taxpayers. Meanwhile, schools are underfunded, infrastructure is crumbling, and basic services are being cut. The pension obligations are crowding out everything else. I have looked at the Illinois numbers in detail. The required pension contributions are consuming an ever larger share of the state budget. In some years, pension contributions have grown by double digits, while other spending has been cut. Roads are deteriorating. Universities are losing faculty. Social services are being reduced. All because money that could have gone to current services must instead go to fund promises made decades ago. New Jersey faces a similarly dire situation. For years, governors of both parties skipped or reduced pension contributions to balance the state budget. They made promises they knew they could not keep. They used accounting gimmicks to hide the true size of the problem. Now New Jersey's pension system is funded at less than 50% by honest accounting. The state faces annual required contributions that consume billions of dollars that could otherwise go to schools, transportation, and other priorities. Kentucky is another cautionary tale. The state's pension system for public employees is one of the worst funded in the nation. Teachers in Kentucky have seen their colleagues in other states receive full retirement benefits while they face the prospect of significant cuts. The state has tried various reforms, but the hole is so deep that there is no easy solution. Connecticut, despite being one of the wealthiest states in the country on a per capita basis, faces a massive pension crisis. Decades of underfunding have left the state with pension obligations that consume an enormous share of the budget. The wealthy suburbs around New York City generate significant tax revenue, but much of that revenue goes to pay for promises made to workers who retired years ago. At the local level, the situation is often even worse. Cities like Chicago, Dallas, and Houston have pension systems that are dangerously underfunded. Some smaller cities have already seen their pension funds fail or come close to failing. Detroit's bankruptcy in 2013 resulted in pension cuts for city workers, something that was previously considered unthinkable. Detroit was a wake-up call, but most people hit the snooze button. They told themselves that Detroit was unique, that it could not happen elsewhere. But the same dynamics that destroyed Detroit's finances are present in cities and states across the country. The only difference is the timing. The multi-employer pension crisis is perhaps the most acute. The Central States Pension Fund, which covers truckers and other transportation workers, was projected to become insolvent within just a few years before emergency federal intervention. Over 350,000 workers and retirees faced benefit cuts of up to 60%. These are not abstract statistics. These are real people who spent decades driving trucks across America, who were promised a secure retirement, who now face the prospect of seeing their benefits slashed. Many of them are too old to go back to work. Many of them have no other savings. For them, the pension crisis is not a future threat. It is a present reality. Congress passed the American Rescue Plan in 2021, which included about $86 billion in bailout funds for struggling multi-employer plans. This delayed the immediate crisis, but did not solve the underlying structural problems. The bailout money will eventually run out, and the fundamental imbalance between promises and funding will remain. Let me share some historical parallels that I find instructive. In the 1970s and 1980s, the United Kingdom faced a pension crisis in many of its nationalized industries. Coal miners, steel workers, and others had been promised generous pensions that the struggling industries could not afford. The government had to step in repeatedly with bailouts and restructurings. The ultimate resolution involved privatization, benefit cuts, and taxpayer subsidies. The process was painful and politically divisive. Sound familiar? In 2001, Argentina defaulted on its sovereign debt after years of fiscal mismanagement. Part of that mismanagement involved pension obligations that the government could not afford. When the crisis hit, pensioners saw their benefits slashed. The social unrest that followed toppled governments. The economic depression that followed took years to recover from. Japan has been dealing with a slow-motion pension crisis for decades. Their demographic challenges are even more severe than ours, with an aging population and declining birth rates. The Japanese government has responded with repeated bailouts funded by money printing and debt issuance. The Japanese yen has weakened significantly over time. Retirees have seen their purchasing power eroded, even as nominal benefits were maintained. These historical examples share common threads. Promises that could not be kept, denial and delay by politicians, eventual crisis that forced painful adjustments. In every case, someone bore the cost, whether it was retirees through benefit cuts, taxpayers through higher taxes, or everyone through inflation and currency debasement. The American pension crisis will follow a similar pattern. We are in the denial and delay phase now. The crisis phase is coming, and someone will bear the cost. The only question is who. Now let me explain why this pension crisis could trigger a broader market crash, because this is where it gets really dangerous. The first mechanism is through forced selling. As pension funds become more stressed, they are forced to sell assets to meet benefit payments. This selling pressure can push down asset prices, particularly in less liquid markets. If many pension funds are selling at the same time, perhaps during a market downturn when their funding levels deteriorate most rapidly, the selling pressure can become overwhelming. We saw a terrifying version of this dynamic in the United Kingdom. In September of 2022, British pension funds had been using a strategy called liability-driven investing, which involved leveraged positions in government bonds. When bond yields spiked unexpectedly, following a controversial government budget announcement, the pension funds faced margin calls. They had to sell government bonds to meet those margin calls, which pushed yields higher, which triggered more margin calls, creating a vicious spiral. The Bank of England had to intervene with massive bond purchases to prevent a complete financial meltdown. Without that intervention, the British pension system might have collapsed, taking large parts of the British financial system with it. The crisis was contained, but it showed how fragile pension-related financial structures can be. Something similar could happen in the United States. American pension funds hold trillions of dollars in assets. If they are forced to sell en masse, the market impact would be enormous. Stock prices would fall. Bond prices would fall. Real estate and private equity valuations would be written down. The fire sale dynamic could feed on itself. The second mechanism is through the banking system. Banks hold significant amounts of municipal bonds issued by states and cities with pension problems. If those governments face fiscal crises due to pension obligations, their bonds could default or be downgraded. Bank balance sheets would suffer. Credit availability would tighten. The real economy would be affected. We have already seen how quickly bank problems can spread. In March of 2023, Silicon Valley Bank and several other regional banks failed. The contagion spread rapidly until the federal government stepped in with extraordinary support. Now imagine a scenario where multiple state and local governments are simultaneously struggling with pension-driven fiscal crises. The stress on the banking system could be severe. Regional banks in particular have significant exposure to municipal bonds from their local governments. A bank in Illinois holds Illinois municipal bonds. A bank in New Jersey holds New Jersey municipal bonds. If those states face pension-driven fiscal crises, their local banks will suffer disproportionately. The third mechanism is through consumer spending. Millions of Americans are counting on pension benefits for their retirement income. If those benefits are cut or eliminated, retirees will have less money to spend. Consumer spending will decline. Businesses that depend on retiree spending, particularly in healthcare, leisure, and retail, will suffer. The economic contraction will reduce tax revenues, making government fiscal problems even worse. This is not hypothetical. We have seen what happens when pension benefits are cut. In Detroit, retirees who had their benefits reduced were forced to make difficult choices. Some went back to work in their 70s and 80s. Some moved in with family members. Some cut back on health care and other necessities. The human cost was real and substantial. Multiply that by millions of people and you have a significant macroeconomic event. Consumer spending is about 70% of the American economy. A meaningful reduction in spending by tens of millions of retirees would be recessionary. The fourth mechanism is through the political system. As pension crises intensify, the political response could create additional market disruptions. Politicians might raise taxes sharply on corporations and wealthy individuals, reducing investment and economic growth. They might impose financial transaction taxes or other measures that harm market liquidity. They might nationalize or dramatically restructure private pension systems. Political uncertainty itself can cause market volatility. We are already seeing political polarization around pension issues. Conservatives argue for benefit cuts and structural reforms. Progressives argue for tax increases and expanded benefits. Neither side has a realistic plan to address the full scope of the problem. The political stalemate makes it likely that the crisis will be addressed only when it becomes acute, and the solutions implemented in a crisis are rarely optimal. The fifth mechanism is through contagion effects. Financial crises rarely stay contained. They spread through interconnected systems in ways that are difficult to predict. A pension crisis in one state could trigger rating downgrades that affect other states. A failure of one major pension fund could cause investors to flee similar funds. Fear itself becomes a driver of the crisis. I saw this during the 2008 financial crisis. What started as a problem in subprime mortgages spread to prime mortgages, then to mortgage-backed securities, then to the banks that held those securities, then to the insurance companies that had guaranteed those securities, then to the money market funds that had invested in bank commercial paper. Each domino knocked over the next. The pension system is similarly interconnected. Public pensions, private pensions, multi-employer pensions, the PBGC insurance system, the municipal bond market, the banking system, all of these are linked. Stress in one area can propagate to others. Let me explain the specific transmission channels in more detail. Pension funds are among the largest institutional investors in the world. In the United States alone, pension funds control assets measured in the trillions. When they buy, they move markets. When they sell, they move markets. And when they are forced to sell during periods of stress, they can create cascading effects that amplify market declines. Consider what happens when a pension fund becomes seriously underfunded. The fund's board and investment staff come under pressure to improve returns. They may shift into riskier assets, chasing higher returns to close the funding gap. This works in bull markets, but it magnifies losses in bear markets. When the bear market comes, the already underfunded pension fund suffers even greater losses, pushing it closer to insolvency. At that point, the fund may have no choice but to sell assets to meet benefit payments. But selling into a falling market locks in losses and reduces the asset base further. Other pension funds facing similar pressures are doing the same thing. The selling feeds on itself. This dynamic is particularly dangerous in less liquid markets like real estate and private equity. Pension funds have dramatically increased their allocations to these alternative investments in search of higher returns. But when they need to sell, there may not be buyers at reasonable prices. Valuations that look solid on paper turn out to be illusory when actual transactions have to occur. I remember this dynamic vividly from 2008. Assets that were supposedly safe and liquid turned out to be neither. Markets that were supposed to be deep and resilient froze up entirely. Prices fell not because of fundamental factors alone, but because forced selling created a cascade of margin calls and liquidations. The pension system has the potential to create similar dynamics. Trillions of dollars in assets, forced selling under stress, interconnected markets, leverage embedded in various structures. All the ingredients for a systemic event are present. Let me talk about what this means for investors, because understanding the pension crisis is essential for navigating the markets in the coming years. First, you need to understand your own exposure. If you are counting on a pension, whether public or private, you need to assess the funding status of your plan. Is it well-funded or severely underfunded? Is the plan sponsor, whether a government entity or a corporation, financially strong or struggling? What happens to your benefits if the plan fails? Many people assume their pension is guaranteed, but it is not. Public pensions in some states have constitutional protections, but those protections can be challenged or modified in bankruptcy. Private pensions are insured by the Pension Benefit Guaranty Corporation, but the insurance has limits. The maximum guaranteed benefit is far below what many workers have been promised. If you are depending on a pension from a severely underfunded plan, you should be preparing for the possibility of reduced benefits. I would encourage everyone with a pension to request the annual funding report from their plan administrator. Read it carefully. Understand the assumptions being used. Calculate what your benefits would be if the plan failed and you had to rely on PBGC insurance. Make alternative plans if necessary. Second, you need to understand the investment implications. The pension crisis will create winners and losers in the markets. Understanding who benefits and who suffers can help you position your portfolio. States and cities with severe pension problems will face higher borrowing costs. Their municipal bonds may underperform or even default. If you hold municipal bonds, you need to be selective. Avoid bonds from governments with severe pension problems. Focus on well-funded states and essential service revenue bonds that are less exposed to general fiscal stress. Corporations with large pension obligations face similar risks. Their stock prices may suffer as investors recognize the pension drag on earnings and cash flow. Their credit ratings may be downgraded as pension obligations consume cash that would otherwise go to debt service. If you are evaluating individual stocks, you need to look at the pension situation on the balance sheet. It is not just about current earnings, it is about future obligations that could consume those earnings. Financial institutions that serve pension funds could benefit or suffer depending on how the crisis unfolds. Asset managers that run pension money could see redemptions as funds need to raise cash for benefit payments. But they could also see inflows if pension funds are restructured or if bailout money flows into the system. Banks that lend to governments could face credit losses. Insurance companies that provide pension products could see increased demand. Real assets like real estate and infrastructure could be affected as pension funds shift their allocations. Many pension funds have increased their exposure to alternative investments in search of higher returns. If they are forced to sell, valuations in these less liquid markets could decline significantly. On the other hand, if pension bailouts lead to inflation, real assets could benefit as hedges against currency debasement. Third, you need to consider the broader economic implications. The pension crisis is deflationary in some ways and inflationary in others. Benefit cuts and reduced consumer spending are deflationary. Government bailouts, funded by money printing, are inflationary. The net effect depends on policy choices that are difficult to predict. My own view is that governments will ultimately choose inflation over defaults. It is politically easier to debase the currency and pay benefits in depreciated dollars than to tell retirees their checks are being cut. This means that holding assets that benefit from inflation, like commodities, real estate, and stocks of companies with pricing power, may be wise. Gold is particularly interesting in this context. Gold has historically been a store of value during periods of monetary instability and currency debasement. If governments resort to massive money printing to fund pension bailouts, gold could appreciate significantly. I maintain meaningful exposure to gold and gold mining companies as insurance against this scenario. Let me be more specific about how I am positioning for the pension crisis and why. First, I have reduced exposure to long-duration fixed income. If the pension crisis leads to inflation and higher interest rates, long-duration bonds will suffer significant losses. I would rather sacrifice some yield today than face the risk of principal losses when the crisis intensifies. Second, I have increased exposure to companies with clean balance sheets and no pension obligations. These companies will be relatively advantaged compared to competitors burdened by legacy pension liabilities. When the crisis hits, Strong balance sheets will be rewarded. Third, I have maintained significant cash reserves. Cash provides optionality. When the pension crisis triggers a market sell-off, I want to have the resources to buy quality assets at distressed prices. The best investments of my career have come during periods of market panic when I had cash available to deploy. Fourth, I have exposure to gold and gold mining companies. Gold serves as insurance against monetary debasement. If governments print trillions to bail out pension systems, gold will likely appreciate in nominal terms, even if it merely maintains its purchasing power in real terms. Fifth, I have invested in companies that could benefit from pension restructuring. There are firms that specialize in pension risk transfer, helping corporations and governments manage and offload pension obligations. As the crisis intensifies, demand for these services will increase. Sixth, I am avoiding municipal bonds from states with severe pension problems. The risk-reward is unfavorable. You receive modest yields in exchange for significant default or downgrade risk. There are better places to earn income. Seventh, I am cautious about real estate in pension-stressed areas. If Illinois or New Jersey face fiscal crises, property values in those states could suffer. Tax increases to fund pensions make real estate less attractive. Economic decline as businesses and residents flee makes real estate less valuable. Geographic diversification is prudent. Fourth, you need to be prepared for market volatility. The pension crisis will not unfold smoothly. There will be periods of acute stress when a major plan fails or a state faces a fiscal emergency. Markets will react with fear and panic selling. Prices will overshoot to the downside. These moments of crisis create opportunity for disciplined investors. If you have cash available and the emotional fortitude to buy when others are selling, you can acquire quality assets at depressed prices. The key is being prepared in advance, having a plan for what you will buy if prices fall significantly. Having the liquidity to execute that plan. Having the conviction to act when everyone else is paralyzed by fear. Let me also address what I think will happen politically, because the political response will shape how this crisis unfolds. The most likely near-term response is continued denial and delay. Politicians will make incremental adjustments, tweaking contribution requirements, adjusting benefit formulas for new employees, and hoping that strong investment returns will bail them out. This has been the pattern for decades, and it is likely to continue until it cannot. When incremental approaches fail, the next stage will be more dramatic interventions. Some states may attempt to reduce benefits for current workers and retirees, leading to legal battles that could take years to resolve. Some states may impose large tax increases that accelerate outmigration of businesses and wealthy residents, worsening the fiscal spiral. Some states may seek federal bailouts, which will be politically contentious. Federal bailouts are almost certain eventually. The alternative, allowing state and local governments to default on pension obligations or go bankrupt in large numbers, would be economically and politically devastating. The federal government stepped in for the multi-employer plans. It will step in for state and local plans if necessary. But federal bailouts come with costs. They will be funded by some combination of taxes, borrowing, and money printing. They will create moral hazard, rewarding states that were fiscally irresponsible and potentially encouraging more irresponsibility. They will require political compromises that satisfy nobody fully. The ultimate endgame may be a fundamental restructuring of how retirement is funded in America. We may see a shift away from defined benefit pensions, which promise specific benefits regardless of cost, toward defined contribution plans, which promise only specific contributions, with benefits depending on investment returns. We may see means testing of Social Security and Medicare, reducing benefits for wealthier retirees. We may see increases in retirement ages to reflect longer lifespans. We may see entirely new structures that we cannot predict today. These changes will create winners and losers. Those who understand the trajectory and position themselves accordingly will do better than those who assume the current system will continue unchanged. Let me elaborate on the political dynamics, because they are crucial to understanding how the crisis will unfold. Politicians have powerful incentives to avoid addressing the pension crisis honestly. Telling voters that their promised benefits may be cut is political suicide. Telling taxpayers that their taxes need to rise dramatically is equally unpopular. The path of least resistance is to delay, to use optimistic assumptions, to hope that investment returns will bail everyone out. This dynamic explains why the crisis has been allowed to build for so long. Every governor who kicks the can down the road is rewarded in the short term. The consequences fall on future governors and future taxpayers. The system incentivizes irresponsibility. But eventually, the can cannot be kicked any further. Eventually, the mathematics become undeniable. Eventually, someone has to make hard choices. When that moment comes, it will likely come suddenly and without much warning. That is how financial crises work. Things that cannot go on forever eventually stop, and they often stop abruptly. I have studied the political economy of financial crises extensively. There are predictable patterns. First, denial. Officials insist there is no problem or that the problem is manageable. Second, acknowledgement. The problem becomes too large to ignore, but officials insist it can be solved with modest reforms. Third, crisis. Events force immediate action, usually in a chaotic and suboptimal manner. Fourth, resolution. A new equilibrium is established, but only after significant damage has been done. We are somewhere between the first and second stages in most jurisdictions. Some places, like Illinois, have moved into the third stage. The federal government is still largely in denial, focused on other priorities. But the transition from denial to crisis can happen quickly. When I predicted the housing crisis, I was years early. I saw the problems in 2005, but the crash did not come until 2008. 3 years of being early felt like being wrong. But eventually I was proven right, and the magnitude of the crisis exceeded even my expectations. I expect a similar pattern with the pension crisis. The timing is uncertain. It could be next year, or it could be 5 years from now. But the outcome is mathematically certain. Promises that cannot be kept will not be kept. The only question is how the breaking of those promises unfolds. Now let me give you my specific recommendations for how to protect yourself from the pension crisis. If you have a pension, do not assume it will be paid in full. Hope for the best but prepare for the worst. Develop additional sources of retirement income that do not depend on your pension. Build savings in personal retirement accounts like 401k plans and individual retirement accounts. Reduce your expenses so you can live on less if necessary. Consider working longer to increase your savings and delay drawing on potentially at-risk benefits. If you are considering a job that offers a pension, evaluate the pension plan's funding status as part of your compensation analysis. A pension from a well-funded plan is worth much more than a pension from a severely underfunded plan. Do not accept a lower salary in exchange for a pension that may never be paid in full. If you are an investor, adjust your portfolio to account for pension-related risks. Avoid municipal bonds from fiscally stressed governments. Be cautious with stocks of companies that have large pension obligations relative to their market capitalization. Consider allocations to gold and other real assets as hedges against currency debasement from eventual bailouts. Maintain liquidity so you can take advantage of opportunities that arise during periods of crisis. If you are a business owner or executive, understand the pension obligations on your balance sheet. If you have a defined benefit plan, consider strategies to reduce that liability over time, such as offering lump sum buyouts to vested participants or purchasing annuities to transfer the obligation to an insurance company. These strategies have costs, but they provide certainty and remove a significant risk from your business. If you are a voter, educate yourself on the pension situation in your state and city. Understand which politicians are being honest about the problem and which are making promises they cannot keep. Support reforms that put pension systems on a sustainable path, even if those reforms are painful. The longer we delay addressing this crisis, the worse it will be when it finally arrives. Let me add some more specific advice for different situations. If you are a young worker just starting your career, understand that the pension system you are being promised may look very different by the time you retire. Do not count on it as your primary source of retirement income. Build your own savings aggressively. Take advantage of 401k matches if your employer offers them. Open an individual retirement account and fund it every year. Your future self will thank you. If you are a mid-career worker with significant years until retirement, you have time to prepare, but not time to waste. Assess your pension plan's health. If it is underfunded, start building alternative income sources now. Diversify your investments geographically. Do not have all your assets in the same state where your pension is at risk. Consider developing skills that would allow you to work part-time in retirement if necessary. If you are nearing retirement or already retired, your situation is more urgent. You have less time to adjust and fewer options. If your pension is from a severely underfunded plan, you need to make contingency plans now. Can you reduce your expenses significantly if benefits are cut? Do you have other assets you could draw on? Could you return to work if necessary? These are uncomfortable questions, but better to face them now than be surprised later. If you are a public sector worker in a state with severe pension problems, you face a particularly difficult situation. Your employer may not be able to increase your compensation to offset pension risk. You may have limited ability to move to another jurisdiction. Focus on what you can control. Build personal savings. Reduce expenses. Develop marketable skills that would give you options if your pension is cut. If you are a business owner considering locations for your company, factor in pension-related fiscal stress. States with severe pension problems will face pressure to raise taxes. They may cut services that your employees and business depend on. They may become less attractive places to live and work. All else equal, locating in a fiscally healthy state reduces your long-term risk. Let me be clear about what I am not saying. I am not saying that all pensions will fail. Many pension plans are well-funded and will pay their promised benefits. I am not saying that a market crash is imminent. The timing of crises is notoriously difficult to predict. I am not saying that you should panic. Panic is never a good investment strategy. What I am saying is that the pension crisis is real, it is large, and it is coming. The risks are significant and underappreciated. Prudent investors should understand these risks and position themselves accordingly. Let me close with some broader thoughts on what the pension crisis tells us about the American economic system. The pension crisis is fundamentally a crisis of promises. For decades, politicians, corporate executives, and union leaders made promises to workers about their retirement security. Those promises were not backed by adequate funding. They were based on optimistic assumptions that did not pan out. They were kicked down the road for future generations to deal with. Now future generations are here, and the bill is coming due. The workers who were promised secure retirements are discovering that those promises may not be honored. The taxpayers who were not consulted about these promises are being asked to fund them. The young workers entering the labor force are inheriting a system that is fundamentally broken. This is not just a financial crisis. It is a crisis of trust. Trust in institutions. Trust in promises. Trust in the social compact between generations. When that trust is broken, the consequences extend far beyond dollars and cents. I have spent my career looking for the hidden risks that others overlook. The pension crisis is not hidden. The data is publicly available. The actuarial reports are published. The funding gaps are documented. But most people are not paying attention because the consequences seem distant and abstract. They are not distant. They are arriving now. Plans are failing. Benefits are being cut. States are facing fiscal emergencies. The crisis that has been building for decades is entering its acute phase. I want to share one more thought about why this crisis is so difficult for most people to see clearly. Humans are wired for short-term thinking. We evolved in an environment where immediate threats mattered and distant threats could be ignored. A lion charging at you demanded attention. A drought that might come in 10 years did not. This served us well on the savannah, but serves us poorly in modern finance. The pension crisis is a distant threat for most people. Retirement seems far away, the funding gaps are abstract numbers, the consequences are uncertain and hard to visualize. So people ignore it. They assume someone will fix it. They go about their daily lives without giving it a second thought. But this is exactly how financial crises build. Slowly, gradually, invisibly, until suddenly they are undeniable. The housing crisis built for years while most people ignored the warning signs. The pension crisis has been building for decades. The warning signs are even more obvious. The data is even more publicly available, and still most people are ignoring it. I have learned over my career that the biggest opportunities come from seeing what others refuse to see. In 2005 and 2006, most investors refused to see the problems in the housing market. The data was there. The documentation was there. Anyone who looked could see the disaster coming. But almost no one looked, and those of us who did were dismissed as cranks or pessimists. The same dynamic is playing out with the pension crisis. The data is there, the actuarial reports are published, the funding gaps are documented. Anyone who looks can see the problems, but most people are not looking. They are trusting that the system will continue as it always has. They are assuming that their promised benefits will be paid. They are not preparing for a different outcome. This creates opportunity for those of us willing to see reality clearly and position accordingly. I am not happy about the pension crisis. I wish it did not exist. I wish the millions of workers who were promised secure retirements would actually receive them. But wishing does not change mathematics. The promises exceed the funding. Something has to give. My role, as I see it, is to understand the situation clearly and to share that understanding with others who want to hear it. You can do with this information what you will. You can dismiss it. You can ignore it. You can assume that I am wrong. That is your choice. But you cannot say you were not warned. I am not telling you this to frighten you. I am telling you this because knowledge is power. Understanding the pension crisis allows you to prepare for it. Preparing for it allows you to protect yourself and your family. Protecting yourself allows you to not only survive, but potentially thrive as this crisis unfolds. The investors who did best during the 2008 housing crisis were not the ones who were surprised. They were the ones who saw it coming, who understood the risks, who positioned themselves accordingly. The same will be true for the pension crisis. I have done my analysis. I have positioned my portfolio. I have prepared for what I believe is coming. Now you have the information to do the same. What you do with it is up to you. The pension crisis is real. It is large. It is arriving. The mathematics are inexorable. The demographics are unfavorable. The political will to address the problem honestly does not exist. But you do not have to be a victim. You can prepare. You can diversify. You can build alternative sources of retirement income. You can position your investments to benefit from the disruption rather than be destroyed by it. The time to act is now, before the crisis reaches its peak, before the markets fully price in the risks, before your options become limited. Do not wait for politicians to solve this problem. They will not. Do not assume that someone else will protect you. They cannot. Take responsibility for your own financial future. That is what I have done throughout my career. That is what I am doing now. And that is what I am encouraging you to do. The pension crisis is coming. Be ready. And let me leave you with one final thought. The pension crisis, as damaging as it will be, is also a symptom of a larger problem. It is a symptom of a society that has lost the ability to make hard choices, to tell difficult truths, and to plan honestly for the future. We have become addicted to promises without funding, to consumption without production, to today at the expense of tomorrow. The pension crisis will force us to confront these uncomfortable truths. It will force us to make choices we have been avoiding. It will be painful. But on the other side of that pain, there is an opportunity to build something better. A system based on honest accounting. A system where promises are backed by funding. A system that does not burden future generations with obligations they did not create and cannot afford. Whether we seize that opportunity or simply muddle through to the next crisis remains to be seen. But for you, the individual investor, the individual worker, the individual citizen, the imperative is clear. Understand the situation. Prepare for what is coming. Take responsibility for your own financial future. Do not rely on promises that may not be kept. That is the lesson of the pension crisis. That is the lesson of every financial crisis. Those who see clearly, who prepare diligently, and who act decisively will thrive. Those who deny, delay, and hope for the best will suffer. The choice is yours. Choose wisely.